Bill, first, I know you're not you're a long-term investor. We all know that. Anybody who's been tuning in and watching your appearances through the years knows that. But I am curious as to what your thoughts are about this current market environment. Is it simply one that gives you more opportunity, or when you see the S&P down 2%, are you concerned there's more to come?
Well, first, thanks for having me, David. And you're right. At Oakmark, we try to think about everything in a 5 to 7 year time frame. And to us, the concern that's out there about a recession, inflation, the fact that we're in a bear market right now, we've gone back and looked, and I wrote about this in my quarterly report. There's no evidence at all that once we know that those are the economic conditions, that you can profit from it by getting out of the market. So many people act as if because there's a recession or high inflation that we should be getting more conservative, but it's too late. And the returns after we know we're in a recession, after we know we're in a high inflation environment, if you sit it out for a couple years, the returns are just as good as they are at any other time. So to us, as prices get lower, it's more opportunity, and we get more excited about forward returns.
Yeah. All right. Well, specific to, let's go to some names. Disney being one of them. Certainly we cover it pretty closely here and know the company well. What is it you see as the opportunity there, Bill, given obviously the stock has been cut in half roughly over the last year?
Right. Disney's one of those companies that as a value investor, you rarely get the opportunity to buy because everyone recognizes what a great company it is. The strong park franchise, the ESPN network's probably the best cable network, most valuable cable network. And because of that, the stock usually sells at a pretty healthy premium to the S&P 500. But if you look at where it is today, after it's been cut in half, if they weren't investing so heavily in streaming, and that's an investment we think they should make, but it goes straight through the income statement. If they weren't making that investment, the stock would be at 14 times expected earnings, roughly a 10 or 15% discount to the market. And that's valuing streaming at zero. We think with the back catalog and the direct-to-consumer history that Disney has, that they should be one of the winners in streaming, and we think that will eventually be a very valuable business for them. And currently, we think we're getting paid to take that risk. We're not paying anything for streaming, and we're getting the rest of the business at a bargain price.
Yeah, you also have a position in Netflix. And when it comes to streaming overall, though, Bill, there is a thought among some that says this will never be anywhere near as profitable as the cable ecosystem that certainly those of us of a certain age have grown up with. And that, in fact, given the amount of invested capital, you'll never really get a substantial return, and that the business may have to change significantly. You're not a believer in that. You think Disney and Netflix can succeed.
Well, right. First off, I think from a consumer perspective, if you get 4 or 5 streaming services, you're probably still paying less than you were paying for your monthly cable bill, so the consumer is better off. But if you think about the cable infrastructure that we grew up with, David, you had a production company that was making a 40% margin. You had the cable network that was making a 40% margin, and then you had the cable TV company that was making a 40% margin. There's no way that the streamers are going to capture all 3 of those margins. But there's plenty of room for them to have a good margin and have profits for the ecosystem be less than they were in the cable system, the consumer to get a better value, and the streamers to also earn a good return on their investment.